Hey everyone, and thanks for jumping back into the Macroverse. Today, we're going to talk about the most recent jobs report. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and also check out Into the Cryptoverse Premium at intothecryptoverse.com. You can get access to a lot of the charts that you see me frequently talk about on the channel. Let's go ahead and jump in. Now, we're going to break this report down uh, as we go. But just to give you the sort of the 30,000 foot view approach, the unemployment rate moved higher from 3.4% to 3.7%. So we did at least see some softening of the labor market in terms of the unemployment rate. However, we also added, I believe, around 339,000 new jobs, which of course came in very hot and implies that the labor market is relatively tight. Now you might wonder, what's the point of talking about the unemployment rate? How does this affect markets? We've talked about this before. You know, during times like what we're in right now and what we've been in for quite some time, the markets can climb the wall of worry until there's a sufficient reason not to. Okay, so you have plenty of things that we can worry about, right? We can worry about, the debt ceiling, the regional banking crisis, which could have theoretically turned into something bigger had the Fed not intervened. You also have the TGA needing to be refilled, the idea that liquidity is getting sucked out of the system. Of course, we're going to have student loan repayments and whatnot, right? The whole idea is that the list goes on and on, right, as to what there is to worry about. And of course, the markets like climbing the wall of worry. However, there is one thing that has a decent history of causing market downturns, right? And that is a severe loosening of labor market conditions. Now, of course, the Federal Reserve and Jerome Powell would like to achieve what they call a soft landing. Now, a soft landing would be the ability to bring inflation back down to the 2% target without a material increase in the unemployment rate. Now, they are forecasting some move higher in the unemployment rate, but I think they're hoping that it won't go up too much higher, right? Like it might go to 4.5% or something, but I don't really think they want to see it go to say 6% or 7 or 8% or anything like that. So the question, of course, is can the Fed achieve a soft landing? Now, history shows that the likelihood of achieving a soft landing is not very high. Now, we might sit here and say, well, the S&P 500 is actually at the same valuation today that it was back when we first started getting the rate hikes, right? If you think about it, we got the first rate hike back in March of 2022, I believe, and you will see, in fact, that if you go all the way back to March, we're at the same valuation. So we just added, basically 500 basis points to interest rates, and the S&P during that time remains relatively unchanged. Now we went down quite a bit, and then we came back up, but it could immediately give the illusion like nothing's wrong. And there's a chance, as always, that a soft landing could be achieved. However, wherein still lies the issue that I think we have to consider as investors is that inflation is still running hot, right? Core inflation is still at a relatively high level. And so there's no clear evidence yet that the Fed has achieved their goal. And until they do achieve their goal, then I imagine the general mantra, which has been, right, higher for longer. Okay, so the unemployment rate is coming in at 3.7%. Now, is that relevant? Is that a relevant number? If you zoom in, I mean, it is a fairly significant move higher in only 1 month. However, we were also at this same level back in October of 2022. So, to some degree, this is still well within the range that we've been in since early 2022. You can see that we really saw the unemployment rate going down throughout 2021. It's been sort of stabilizing here between 3.4% to 3.7% for basically the last year or so, maybe even slightly longer. And so really, this is not necessarily a major red flag for the labor market just yet, right? It could turn into one if this continues moving to the upside, But at this point, it's not clear evidence in and of itself that the labor market has significantly loosened up. All right. And of course, one of the reasons why we talk about this is because if it were to loosen up, that would likely bring on a recession, right? But you've had people talking about recession now for the last 18 months or so, but you simply do not have a recession when the unemployment rate is at historic lows. Now, of course, the counterpoint being that it's normally once it hits these historic lows for that business cycle that you will see it move back up and go into a recession, right? But it still means that when you're down at these levels, you're not typically in a recession, right? It doesn't mean that one's not coming at some point in the nebulous future, but what it normally means is you're not in one at that time. Okay. Now, you can actually break the unemployment rate down into different sectors. I mean, right now we're just looking at everyone over 16 years of age, but you could even look at, say, full-time workers and see where that is, and that actually recently moved up from 3.3% to 3.6%. You could look at part-time workers, which has not really moved up a whole lot. I mean, it moved from 3.6% to 4%, but just to give you some reference, back in November, it was at 4.4%. So part-time workers' unemployment rate still remains relatively low at only 4%. And of course, you could break this down into other ways as well, right? You could look at the unemployment rate for people only over the age of 55 if you want. And in that case, if we were to zoom in, you can see that it actually was a significant move to the upside from 2.3% to 2.8%. This is the highest level that it's been at since April of 2022. Okay. And then if we maybe look at one more, we can look at maybe the unemployment rate for people between the ages of 25 and 54 to see where that's actually coming in. And you can see that it actually remains relatively low at only 3.1%. So there is some softening of labor market conditions. However, I don't really think at this point it's enough to really justify a recession. Okay. Again, it doesn't mean that one's not coming eventually, but again, the sort of the recession timing is something that's very difficult to predict. You have no idea really when the labor market is going to show that softening. It could take months before you see that, or longer, right, before you see anything like that transpire. Now, I also wanted to talk about a few other things. One of which, of course, is the fact that we had a pretty hot job openings report, right? So in terms of where we've seen job openings come in, you can see, in fact, that total non-farm was at 10.1 million. It's a pretty significant level. Now, in the grand scheme of things, when you look at this, you can see that it has been moving down. It has not been linear, though. So is this just a stochastic process of it moving down? Or is this starting to show some renewed strength because maybe the stock market has been showing renewed strength? And if the markets are doing well, then perhaps people don't feel like they need to lay people off as much. I don't know. But until we get a little bit more data, I mean, it's hard to just take one data point to the bank. I mean, even over here, you can see we increases 2 more months, or over the span of 2 months, and then we still just ended up coming down and putting new lows. Remember, one of the reasons we talk about job openings is because it's because there's so many job openings, I think, that have been able to absorb all of the workers that have been getting laid off, right? So if you're a worker and you've been laid off, there are a lot of job openings still available. And so you could argue that that is one of the reasons why the unemployment rate remains so low, right? Now, when you look at this, you can see that we're still not even really back to trend, okay? And you might not really see the labor market loosen up in terms of the unemployment rate until this actually gets back to trend or below trend. With 10.1 million total non-farm job openings, that's not really at this point considered to be a significant loosening of labor market conditions. Now, if you look at, say, like the year-over-year percentage change, it certainly looks, right, like it looks pretty bad. But you also have to recognize that we are starting from a fairly high level. Okay, now we can break this down and figure out what sectors are adding jobs and what sectors are losing job openings. And if you actually look at, say, like the manufacturing sector, you can see that it actually lost job openings over the last month. And if you were to look at the year-over-year percentage change, it's not heading in a good direction. If you were to look at durable goods, you could see that it also lost jobs over the last month or so. And if you look at the year-over-year percentage change, you can also see that it's not really heading in a great direction. But you could look at other sectors like construction and see that it actually went back up from 315,000 all the way back up to around 383,000. You could look at total private and see that it went up from 8.71 million to 9.14 million. Now, again, when you look at the year-over-year percentage change, it still doesn't really look that great, but it does show you that some sectors are adding jobs while other sectors have been losing them. One that I believe has added a significant amount, I believe, is the arts, entertainment, and recreation. So you can see in that area, just maybe not over this last report, but just in general since November, we went from 164,000 job openings all the way up to 243,000. Now it's pulled back slightly to 237,000, but this was a pretty big move to the upside in a relatively short period of time. Leisure and hospitality actually ticked down in this recent report, and if you were to look at, say, professional and business services, it moved down. And I believe there was one other that I wanted to take a look at. I can't remember which one it was. Yeah, maybe I already covered it because I'm not really seeing. Maybe it was just professional and business services that I wanted to take a look at. That one also has been moving down. If you look at the year-over-year percentage change, right, it's not really doing anything great, but it does show you that there's some sectors that have been adding and some sectors that have been removing job openings. Okay, and of course, as long as inflation is well above the Fed's target, right? If you were to go look at, say, core inflation year over year, as long as it's up here, it would be very premature to celebrate a soft landing, right? How can you celebrate a soft landing just because the S&P is back to where it was when the Fed started hiking rates, when they still haven't really accomplished their objective of getting inflation back down to 2%. Now, that's not to say that a soft landing is impossible, right? Anything's possible, and it's always possible that there's enough liquidity in the system to sort of absorb all of the QT, but there is still an issue here of the Fed has raised rates to 5%, to 5.25%, and core inflation is still at 5.54%, right? So you could argue that they need to get the Fed funds rate potentially above core inflation to have a meaningful impact. Now, right now, markets are sort of suggesting that the Fed's going to pause at the next meeting. I believe the last time I looked, it was about 70% chance of a pause, 30% chance of a hike, but the market is thinking that they might hike in July. So I don't really know. I mean, if it were me, if they're gonna hike, I think they should just go ahead and do it, right? Let's not continue to live in as much as let's try to get inflation out as quickly as we can. And one of the reasons I say that is because when you look at what happened in the 70s, just look at what inflation did. Like, look at what core inflation did back over here. I mean, it moved up, and then we came back down, but the Fed pivoted too early, and then it just went up again. And you can look at what the S&P 500 did, right? Like, it wrecked both sides. It wrecked the bears, but then it just wrecked the bulls and put in a new low. And that's why I go on about this, right? Like, it's not that the S&P can't go up. We know that it can. I mean, like, it generally will climb the wall of worry until it has a sufficient reason not to do so. But the issue is that if we get into a period where the Fed just does not have the courage to do what needs to be done, then you could see inflation just come right back in the next cycle. And then, even though you might put in a slightly higher high, you end up putting in a slightly lower low. And that doesn't even include when you adjust those returns for inflation. So you might be under the illusion that, if you bought over here in 1966, that you might be slightly up by the year 1979, right? 13 years, but adjusted for inflation, you would actually likely be down quite a lot during that period. And it's these types of periods that are really brutal for markets, and they're also brutal for the economy in general, because people you really start to not be able to afford things in the same way that you used to. Who now goes to the grocery store And it feels like you go in and what used to maybe only cost you $100 now costs you $200 or $300. Okay, so we want to hopefully avoid a decade of inflation. But the only way we're going to avoid that is to get inflation down as quickly as we can so that it doesn't become entrenched like it did in the 1970s, right? And then you just basically get, a year or two where the Bulls are right, a year or two where the Bears are right. And when you look back on it 10 years later, you can see that really no progress was actually made in the S&P 500, which is kind of a sobering reality, right? You put in a high, you put in a low. You put in a higher high, you put in a lower low, and then a higher high, and then a lower low. And look at the time period between these. This was 1960. So this low here was in 1966. The next low was 4 years later in 1970. The next low was 4 years later in 1974. It's kind of interesting because we know the Bitcoin cycles tend to operate about every 4 years or so. And so normally when Bitcoin puts in new highs, it's you would think like late 2024, early 2025 if it's going to follow the context of history, right? But if it follows what happened in the 1970s, then that could be a very nasty environment to be in. History shows us the way that you really get inflation back down is to induce a recession, right? And in the 1980s, they actually had to induce two of them because I think they kept doing this stop and go, right? Like QT, QE, or raising interest rates, lowering interest rates before really they should have. And I think once the Fed finally admitted to themselves that they needed to just deal with it, they induced a hard landing, inflation came down, and then we had a decade of economic expansion, right? So that's sort of the thing that I have on my mind. It's not, can the S&P continue to climb the wall of worry? Of course it can. It's just, when can we get to a period of, say, like a decade of expansion like this? And I find it difficult to believe that we could get back to something like this until inflation has come back down in a more sustained way. As long as it's up here at 5.5%, it's kind of hard to get on board with the idea that the S&P 500 is going to give great returns over the next 5 years. Now, if we can get core inflation back down to more reasonable levels, then I think you have a more bullish case. But I do think that is at least something that we have to contend with. It's not to say that risk assets can't go higher. Even in the 1970s, you can see that the S&P was able to push higher. And we had a high in 68. We put in a higher high in 1973. But again, the issue is that we ended up just going down and putting in new lows because we just kept getting recessions because we kept having to deal with inflation. Okay, so that is of course something that I think we have to consider. And then the other thing I wanted to mention is we also can look at the unemployment level by reason for unemployment. And one of these that I suppose is worthwhile to look at is the permanent job losers. So people who are permanently losing their job. That's actually been going up in a material way, right? I mean, if you look at this, it's not just hanging out at the lows. It is starting to move up, right? And I mean, over here, you can see it really started to move up, right? It was at 1.49 million, and we had a recession once it reached about 2 million. Here, it bottomed at around 1.2 million, and now it's at about 1.59 million. But it is starting to move up. And if this continues, then you could start to see it reflected in some of the other areas. And if you were to look at, say, like the year-over-year percentage change, you can see that this has, in fact, gone positive. Now, just because it goes positive does not mean you're in a recession, as you can see by the last two examples of it. But the issue is if it stays like this for a long period of time, then it could really start to have some type of effect on the unemployment rate. And you could also look at say, new entrants to the labor force as well to see really what that looks like. Are people unemployed because they're new entrants into the labor force? Right now, it still is pretty low, but it is slowly starting to move higher. And arguably, if the student loan repayment stuff forces people to go back to work, you could see this continue to move higher. But remember, there's all this stuff to worry about, right? But at the end of the day, the only thing that really matters when it comes to the labor market, right, is when does it actually soften up? When do you see the unemployment rate go up? If you look in history, right, the S&P can climb the wall of worry and it likes to do that. But where it has trouble climbing the wall of worry is when the unemployment rate starts to go up, right? When that goes, that's usually when the market starts to find weakness again. Okay, so until that goes, it would be, of course, premature to assume that that the S&P can't just continue to climb the wall of worry, right? I mean, it would be premature to assume that. It would also be premature to assume that we've already achieved a soft landing, just because the Fed is potentially at a potential pause. Okay. In fact, if you were to go look at interest rates, oftentimes, right, if we were to go look at, say, the effective Fed funds rate and overlay the S&P 500 on this, you'll see that, oftentimes the Fed will raise, they'll pause, the market might rally some, but then at some point, the market will find weakness if the Fed doesn't start cutting soon enough, right? That's what they often do. They go too high, they'll pause, but then at some point, because they haven't lowered rates and the market is screaming for them to lower rates, normally it takes something catastrophic for it to happen for them to want to lower rates, and then they're forced to pivot. One of the reasons that might make them pivot eventually is a material rise in the unemployment rate. But I don't really see any reason to pivot. And by pivot, I mean actually start cutting, as long as you have core CPI coming in at over 5%. I mean, really, as long as it's over 3 or 4%, it's hard to imagine they're going to pivot. Maybe they would at 3% if the unemployment rate gets really bad. But it's difficult to imagine the Fed wanting to start cutting anytime soon if you still have an unemployment rate that's below 4%. You have core CPI that's above 5%. There's just not really a compelling reason. And I think that's where we currently stand with all this. So, we have the jobs report. The total non-farm payroll came in pretty hot, right? So from that stance, the labor market is relatively tight. The unemployment rate moved up to 3.7%, showing some softening, but it's still going to take many more months of data to confirm anything about that data point. And so this is just a very, very long process, right? The business cycle does not just take place over a couple of days. I think if you're in crypto, you want everything to just come at us very quickly, and you want to see the market change very, very quickly. But the reality is that the business cycle can take years to develop. And so the interest rates have been raised significantly. We know that it can take upwards of a year for those to fully be felt in the U.S. economy. We're just now getting into that phase. The market is climbing the wall of worry because the unemployment rate is still relatively low. And if you were to go take a look at say, initial claims, while they have been at somewhat elevated levels compared to where they were, say, last year, they still haven't really moved up in a material way. I think really, in order to see the unemployment rate really start to go, you would need to see these at like the 300,000, 400,000 mark, I believe, before you really start to see the unemployment rate move. I mean, over here it was, you can see this, right? It was at 300,000 and moving higher all the way up to around 400, 500,000. Here again, right? It was 300,000, 400,000, and so on and so forth. With it only at 230,000, it still does show you that the labor market is relatively tight. And then if you were to go look at continued claims, it saw a pretty big move up back in late 2022 and early 2023. But over the last few weeks, it has more or less leveled off. Okay. So when you look at, say, the year-over-year percentage change, obviously it doesn't really look that great. It is starting to get into that positive territory, and normally that corresponds to a recession. But again, it started at a pretty low level, and so I think there has been, some element of wiggle room in it. And for that reason, the unemployment rate still remains relatively low. Okay. So that's essentially my synopsis of the labor market. In general, it is relatively tight. Yes, there have been people that have been laid off, but there's still plenty of job openings. The Fed is still a long way from achieving their objective of 2% inflation, so it would be premature to assume that they've achieved a soft landing. And until we ultimately get the resolution of the yield curve, and until we get back to 2% inflation, it's going to just be an outstanding question, right? And I think people want to know the answer now, but the question mark remains. Until the Fed gets back to their objective, they will likely continue to put pressure on the U.S. economy. And oftentimes it takes a recession to bring inflation back down in a material way. The only question is, of course, is how long does it take us to get there? Does it happen in, say, 3 months, 6 months, 12 months, 18 months, right? That's the hard part. And so that's why we talk about the macroverse occasionally, just to keep an eye on the macroeconomic conditions, right? Is the labor market softening up? Maybe a little bit, but it still has a long way to go before I think it has some type of material effect on financial markets. The other thing to consider is that, of course, markets can correct, right? I mean, you could have a 10% correction in the S&P 500. You could have a 5% correction in the S&P 500, even with a low unemployment rate. You can have corrections for other reasons besides the labor market. But in order for, the S&P to potentially see a new low, I think it would likely have to come on the back of the unemployment rate going up in a material way, or it could be on the back of some major geopolitical event. But it seems silly to try to plan for those because they're so few and far between. So you can't just go through life, right, constantly being worried about a geopolitical event. So I don't really think it's worthwhile to put too much weight on that. I think the main things to think about, of course, are the unemployment rate and inflation, right? And I mean, inflation isn't as big of a deal right now because it has been at least trending in the right direction. But if the Fed, say, were to pivot back to QE before they should, and inflation were to come back again, like a double peak like the 1970s, then inflation does become an issue again, because then the market has to then all of a sudden price in a lot more rate hikes, just like they have in decades past of high inflation. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and again, check out Into the Cryptoverse Premium at intothecryptoverse.com. I'll see you guys next time. Bye.